will be doing what? We will be doing Fibonacci 2 as one of our what? One of our elements of technical analysis. All right. And I said Fibonacci 2. Well, I gave the definition. Who can remind me the definition I gave? There's those people that wrote it out. No, some people were writing now. Eh. Okay. Okay. Then okay. Now I said a Fibonacci 2 eh, is being drawn with a what? With a vertical line. So let me clear this up. Now, a Fibonacci 2, that is a Fibonacci retracement. We are talking about retracement. There are two types of Fibonacci. We have the we have the expansion and the retracement. But today, what we are dealing with is what? Retracement. So now, so a Fibonacci retracement 2 is being what? Drawn with a what? With a vertical line from an obvious low to an what? Obvious high, in such a way that once the vertical line has been achieved from an obvious low to an obvious high, there are some particular ratio that divides that vertical line. What did I say? There are somewhat particular ratios that divide the what? Vertical line, in such a way that those ratios act as a what? As a support or resistance. Are you getting it now? So I said a Fibonacci 2 is a retracement. Okay, a Fibonacci retracement 2 is being drawn with a what? With a vertical line from an obvious low to an obvious high, which means from an extreme low, the one you can see vividly, to an extreme high, in such a way that the demarcation of that vertical line stands for a ratio. Do you get it now? And each of those ratio can act as a support or resistance. Are we following? Now, for an example now, you have an uptrend. So I told you that for every trend, there's always a starting point. So if a trend should start from here and it moves all the way up, boom. Where is the lowest part of this low and where is the highest part of this structure? This is the lowest part. Do you get it now? Of this structure, and this is the highest point. Now, to effectively use your retracement tool, you will connect it from the what? From the lowest point to the highest point. Now, once you connect it from the lowest point to the highest point, there are some particular ratios in between that vertical line that act as what? Support and resistance. Are we following, please? Now, those ratios, we are expected as forex traders to know them. I'm going to give you the figures of those ratios. Do you get it now? Don't forget, I told you that everything you are learning, it has to be registered in your heart. You need to know it. It needs to dwell with you. Is that not so? So for you to know this too, you need to register it in your heart. Each of the ratios, it has been given already, but it's now left for us to what? To know those ratios. Are you getting it now? But how you place them is what matters. You place it from an obvious low to an what? Obvious high. And each ratios within that vertical line stands as what? Support and resistance. Are we following? Now, sorry, I'm coming now. Now, I want you to write this. Now, I want to give you the ratios that divides that vertical line. So, the ratios for your retracement, the ratios for your fib retracement, fib means what? Fibonacci, is that not so? Are 1, 0.236, 2, 0.382, 3, 0.500, 4, 0.618. Then the fifth one, 0.764. So these are the given ratios of your Fibonacci retracement that can act as what? Support and resistance when market what? Gets there. Are we following, guys? The first one, 0.236. The second one, 0.382. The third one, 0.500. The fourth one, 0.618. And the last one, 0.764. All right. Should I move on? Yes, ma'am. Do you now know what Fibonacci retracement tool is? Yes. All right. Just know it that for you to connect that vertical line, there must be two element you are looking at. An obvious what? High and an obvious low. So how you will now place them for any of the structure is what we will need to know next. But now just know how it is being constructed. All right, are we following, guys? So these are the given ratios. Now, in some instance, instead of you seeing 0.236, you can see it as 23.6. Just get the ratio. It's just as if you know how decimal works now. Exactly. Instead of you seeing as 0.382, you can see it as what? 38.2. Instead of you seeing as 0.500, you will see it as what? 50.0. Instead of you seeing like this, you see it as what? 61.8. I'm telling you, in some instance, instead of you seeing this guy, you see 76.4. It still means that it's giving the same ratio. All right. No, I'm talking about this Fibonacci tool. Exactly. These are percentage. Do you get it now? It is still the same thing. Are you following it? So that means that for each ratio of that vertical line you've drawn, it means that the retracement that will be happening, don't forget, I taught you guys market structure. The market move in an impulsive retracement. And I mentioned that the retracement can get to any of the what? Impulsive level to end that retracement to now start another what? Impulsive movement. Do you still remember? Now, these are the ratios you will be looking at for your what? Fibonacci tool. To know exactly where the retracement is going to end, that is why it's called Fibonacci retracement. It makes you to know, to give you an insight of an ending retracement for an impulsive movement to begin. Are you following? So what does that imply? It implies that for you to construct your Fibonacci retracement tool, it has to be well placed. If it is going to be a retracement for an uptrend, you place it from your low to your high. Get that? If you are to get the retracement of your impulsive movement, you place it from your to your, that is, you take the Fibonacci tool, you place it from your what? Obvious low to the high for an uptrend. Yes, impulsive movement. For example, if you have this, everybody look, yes, now impulsive movements. Do you get it now? For example, if you have this and market change from year to year, don't forget, it it has the structure of this guy as what? Has changed to this guy. So from year to year is what? Is your what? Impulsive movement. Because I told you, on higher time frame you will see this like this on a smaller time frame, but when you get to higher time frame, it can be a single candlestick. Do you get it now? All right. So for you to construct your Fibonacci retracement tool, it has to be from the low to the high. Do you get it now? Once you place it, boom, you start looking at the movement of the market on each of these ratios. So this each ratios can act as a what? As a reversal. Exactly. No, it won't be for an uptrend. It will act as a what? Support. Because you are wanting to know the end of the retracement. So these ratios will now act as a what? Support. That when market gets to each of these ratio, will it respect to now start an impulsive movement? Are we following now? So let's continue. Now, traders use the Fibonacci retracement levels as potential support and resistance area. I've mentioned that now. So you are that implies that if market gets to this 23.6 percentage and it breaks it, it is expected that it has now acted as a what? From a support to a resistance, and it will go down to the next level, which is what? 38.2. And if it breaks 38.2, it comes down to the next one. So what will be your confirmation? Your candlestick pattern. So if any of the candlestick pattern does not give you a signal on each of those ratios, that means that it will not hold. Then you are looking at the movement at the next percentage. Are we following, please? So the traders use the Fibonacci retracement level as potential support and resistance area, since so many traders watch these same levels as place to buy and sell orders on them to enter trades or place stops. The support and resistance level tend to become a self-fulfilling prophecy. That is, it gives you a foresight. Don't forget, I told you that once you draw your retracement to from the low to the high, it gives you a foresight at which you are expecting a retracement to end, for you to now get a what? A bullish candlestick pattern for the next impulsive movement. Are we following? So what will be your confirmation on each of these ratio levels? Your candlestick pattern with other confluences, probably the zone you've drawn or your minor zone. Do you get it now? Or your support channel, resistance channel. If it should collide with each of these ratios, you can see it as a what? Confluence point. Boom. Then the confirmation will now be your what? Your candlestick pattern. Nobody should sleep. Oh. Are we following, please? Now, please, you need to memorize these ratio levels. Don't, no problem, it's there. The tool is there, but just make sure you are aware of this what? Of these ratio levels. They are very, very important. Very, very important. Now let's go to real time. Now, okay. Let's say calm down. Go up, Eh, now, the beauty of this is that you can use your Fibonacci retracement on any time frame. You can use your what? Fibonacci retracement on any time frame to know at which a retracement is going to end, for you to now know the next impulsive movement. Are you following? Now, what you need to know is that the given retracement ratio, the given average ratio for your retracement to end properly, please listen, the given what? Average ratio for your retracement to get to, for an impulsive movement to start from, is within the ratio of 50% to 61.8. Are we following? That does not mean that other ratios are inconsequential to your analysis. They are very important, but the average ratio at which your retracement will get to is what? So you are expecting that when the retracement happens, it should get to what? 50% retracement or 61.8 retracement. Please, are we following? It is very important to know all these things. It is very important. Now, let's look for an obvious what? An obvious low, an obvious high. Look at this. Look at this, guys. Look at this, guys. Now we want to do practical. I believe you can all hear me, right? Please, sorry guys, I'm trying to take profit new. So, all right. Now, everybody look at the screen. Can we all hear my voice? Okay, perfect. Now, from an obvious low, if you are to draw your Fibonacci retracement in a what uptrend situation, what is your impulsive? In an uptrend situation, what is your impulsive? The green candles, the buying abi. What is your retracement? The sellers. So for you to know your retracement, you place it from an obvious what? Low. Now, for example, now let us see the market structure of this uptrend. Are you seeing it, guys? Of this uptrend from here up. So this is the starting point, right? So where is the next higher high? Somebody should show me. No. Yes. Are you getting it? No. So you need to have a very what sharp eye for you to get it. So this is the starting point, and this is the higher eye. Is that not so? So for you to now know the retracement of this impulsive movement, you will take your Fibonacci retracement. Are you seeing the two? From your what low to the what higher high. Are you seeing the level of this zero? So the level of this zero must be at the tip. At the what? God bless you. Boom. Then once it's at the tip, then the retracement that happens must get to your what? To your ratios. Can you see the ratios? Guys, can you see the ratios? Number one, what can you see? 382. Do you get it now? The second one, you can see what? The next one, you can see what? The next one, you can see what? Are you following? It's still the same ratio I gave you, right? Are you seeing it? 0.236, 23.6. 0.382, 38.2. Still the same thing. Are you following? 0.61. So you can see that from my own setting, I removed what? 0. Why did I remove it? Because I am not seeing that. Don't forget, I said that what you are looking at is your what? 50% and 61.8 as the average retracement. Not that 23.6 will not respect, though, it will, but most of the times it breaks. You can do it from your setting. Yes. So why did I remove it? I remove it in such a way that when market gets to your 23.6, imagine I now enter an impulsive movement there, boom, and market is still coming all the way down to this point. Is that not a drawdown? So what candlestick pattern are you looking at for entry? The higher the time frame, the higher the possibility of your analysis. The lower the time frame, the lower the possibility of your analysis. So if you are looking at your retracement, you are to look it at what? At an higher time frame. 1 hour is still a good time frame. See, I'm just using 30 minutes as an example to show you how to place your what? Your retracement to. Are you following, guys? So now, can you now see the retracement? What level did it get to? Boom. When it gets to 0.5, what happened there? Market starts what? Creating another impulsive movement. Please, are you following, guys? Now, do you not see the power of Fibonacci retracement? It has to be from a what? From a low to a high for you to now know the what? The retracement at which is going to end for the next impulsive movement to start. Now, once you place your Fibonacci from a low to the high, you come down to a lower time frame. Now, I'm using 30 minutes as my analysis. So for me to now use an entry level for my execution, what time frame will I come to? 5 minutes. That is for people using what? Smaller. I'm doing my analysis on 30 minutes, oh, which I don't advise. But I'm using this 30 minutes to teach you how to what? Place your Fibonacci retracement tool. Please, are you following, guys? Now, I placed it from this low to this high on my 30 minutes. So now I'm now looking for entry level in my 5 minutes on that line. Do you see it got to 38.2? Did you see any bullish candlestick pattern for you to buy? See the movement of the retracement from here. It's coming all the way down. Boom, boom. It's got to 38.2. Any bullish candlestick? It came down to 50%. Any bullish candlestick? What candlestick pattern is this? God bless you. Then once you see three inside up, that is the name of the bullish candlestick pattern. Then what will now happen from here? Once you see this candlestick pattern, you place a what? A long. So where will be the stop loss? Below the liquidity. Are you seeing this, guys? Now, you are expecting that when the next movement continues, boom, it is coming back to your what? To the eye of that what? Of that impulsive movement. It's now either it breaks this eye or it does not break it. So this point, you use it as your what? TP level. As your what? Take profit level. It might not be your TP1, but it should be considered as your what? Take profit level. Are you following, please? And you are now expecting that once it breaks, boom, this market gets to your minus 0.27. Can you see this? So it is expected that if a market should start an impulsive movement, it will get to your minus 0.27 fib level as your what? As your take profit area. Most forex traders don't know this. As a matter of fact, it is not part of your Fibonacci ratios. You cannot see it. But how was I able to know it? I was able to know this because I did my research. I was learning from a master, a forex master. His name is Dr. Willis. And Dr. Willis said that for you to take a trade, always make sure that your TP are at the what? At the previous high for an uptrend scenario, because you are expecting that the impulsive movement continues. It's either it breaks this high or not. But you've entered from here, so this place will be your TP area. And he said once it breaks it, it should get to your what? Minus 0.27 fib level. And I've done it over and over again. Market gets there. Most of the times, market what? Gets there. Once it breaks the previous high, boom. So you use this minus 0.27 as your what? As your TP area also. Are we following, please? It's not on the fib. That is what I'm saying. That is what I'm saying. I got it from my research. Naturally, it is not in your what? In the ratios of your Fibonacci. The given ratios are the one I listed out for you guys. But this minus 0.27 is not part of it at all. But because of my research, the research I did, I was able to discover that you can use this minus 0.27 as your TP level. Once it breaks the previous high, it is expected that this market gets to this what level. Are you following now? You don't need to calculate it. Once you set it, once you set it in your Fibonacci tool. Now this is how to set. Now, let's say you take your Fibonacci anywhere, boom. and you place it, boom. You can what? You will what? Right. Is it left or right? You will right click. Once you right click, you go to settings. Once you go to settings, go to style. Now, these are the what? These are the boxes you can set each of those ratios given. You can see it now. So I set minus 0.27, set 0.5. But once you set it, everything will show here. Are you getting it now? So that is how to what? Set up your Fibonacci. All right.
So this does it work regardless of the level you're placed before, like your zones? Like now, for instance, now this zone is here.
Yes.
This zero, this ignore it. What
No, you won't. You will not ignore it now. You will not ignore it. Don't forget, this is your what? Your minor level. Is that not so? This level you are seeing here, it's your minor level. And our analysis is on what? 30 minutes time frame. Okay, now, guys, are you listening to me? Can you all hear me? Now, let's say now that you know how to place your Fibonacci level, great. Now let's go to a proper way to place your Fibonacci. Don't forget, your analysis is either to be done on what? 4 hours or 1 hour. Boom. Let's continue. Let's continue like that. Now let's look at an obvious high and obvious low. Let's use another instrument. Let's use USD card. Four hours. All right, guys, are we following now? Everyone, are we following? Now, look at this structure. This structure is what? An uptrend. Is that not so?
Yes.
Now, where is the starting point? Yeah.
Yes.
Where's the next higher high? Yeah.
Yes.
How were we able to know that this is the next higher high? Because a red candle was formed. Now, listen to this. Whenever there is an impulsive movement, what will make you know a retracement is that a bearish candlestick starts forming after that was long impulsive movement. So once that retracement begins from that was impulsive movement, then you can now take your what Fibonacci to now know at which the end of that retracement will get to. So if that if that bearish candlestick does not form at the end of your impulsive movement, you are not expected to draw your what? Your Fibonacci retracement. So the work of the retracement is for you to know the end. It's for you to know the what? To know the end at which that retracement will get to now know how you will what? Enter the next impulsive movement. Are we following, guys? So now, this is now let's look at this. We don't know what is happening in the picture. So market starts green, 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 red. Okay. Now the next candle that happened is a red candle. Maybe it's a green candle. Then after a red maribozu. All right. Then when it continues, boom, 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 it break this guy. Do you see it now? It's close below this guy to tell you that the sellers are still what? Are still selling. So once you discover that, now you want to know at which this sell will end for you to know the next impulsive movement. What will you now do? You take your Fibonacci from this low to the high, and wait patiently for market to get to those what ratio levels. Are we following, please? Now, do you see the market? Boom, 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 boom. At which point did this market respect? Now, that is why I told you that the average percentage you should be looking at is what? 50% and 61.8%. Now, when it's got to 50%, what happened? Boom. But how were we able to know first that this market is going to buy? Market sold down, boom, 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 gave us a what? Bullish engulfing bar. Once we add this bullish engulfing bar, you cannot place a buy here to take profit at where? At the previous one. And if it breaks it, it goes to where? Did it get there? The market, yes, now I told you. I've no, you said this market sold after this guy, right? And I've repeated it before that in as much market did not close below this guy, then it has not invalidated what psychology stands for. Do you still remember now? Do you now remember? So you have a bullish engulfing bar. In as much this sell did not close below this guy, this is bullish engulfing bar. You know, we don't, this one was, let's say that what happened was the after effects of this bullish engulfing. We don't know what is happening in the future. This is what we are seeing currently. Are you getting it now? And we are able to get a what? A bullish engulfing. Boom. So once you get a bullish engulfing here, you are expected to now come to a lower time frame to place what? Possible entry. Now let's come down to what? 30 minutes. 30-minute time frame is still good for your what? For your entry. Uh, the Fibonacci will tell us where it is. Lord of Jesus. I don't think we'll be able to because of my subscription. Mm. Now, let's say 1 hour is our what? Is our entry. Now, this is the candle responsible, right? Now, bullish engulfing bar. In fact, on 1 hour time frame, it is what? Morning star. Are you following? Then market. Now you are now waiting for 15 minutes candle to what? For your entry. So now when this candle forms, boom, do you see what it gave? Are you supposed to enter here? No. So you wait patiently till you get a what? A 15 minutes what? Candle, bullish candle for you to enter. Can you see market start retracing all the way down to this point? Then what candlestick is this? Is this a standard one, a strong one, or a weak one? It's a standard one. So you can see what? Take it, because the confluence I've told you that you are at your 50% retracement of this impulsive movement. Then once you enter a buy here, what happens next? To the what? To the previous what? Are you following, guys? And once it breaks above this guy, do you now see the break? This guy, this particular candle is responsible for the breakout above this guy. So you are expecting a new higher high. And it gets to what? Minus 0.27. This is another take profit area. And when it got there, what happened? So whatever happens is none of your concern. You've taken profit here. You've taken profit here. No, you are not taking any stop loss. This is where you are taking your entry. So your stop loss will now be below this what? Or it can be below this what? This 15-minute entry. Are you following, guys? And your take profit is here and what? Here. I'm not sure 15 minutes will, because of the subscription. I'm not sure. I'm not switching. It won't. Okay. Great. All right. Eh, it's no. I told you that whenever you get a confirmation of a candlestick pattern, you come down to after you need to wait after the candlestick pattern has formed. Do you get it now? After it has formed, you will now come down to 15 minutes time frame to now get a what an entry. So if a candlestick pattern should form on 4 hour time frame or 1 hour time frame, let's say 1 hour time frame, that is you are waiting for one, let's say it's the candle pattern formed at 1 o'clock, and I told you that you have to come down to 15-minute time frame for entry. So you are now waiting for 1:15, that is 15 minutes after 1, to now know what the 15 minutes candle will form. If the 15 minutes candle form as a bearish, you are not supposed to enter until you get a what? A bullish signal. But if that 15 minutes form as a what? As a green candle, probably a good maribozu or another bullish candlestick pattern, you can enter. So you are not to enter, that's example, at 1 o'clock, because 1 o'clock will give you the formation of that pattern. Now you are now trying to wait till that what? Till that market gets to 1:15 to know where your 15-minute candle, to know what your 15 minutes candle will form for your entry. Yes, if you are placing on 5 minutes, then you would look out for a bullish candlestick pattern on 5 minutes after the candlestick pattern has formed on 1 hour or 4 hour. That be in 1:05. It has to close, yes. Once it's closed, boom, then you cannot enter. Yeah. I think there is news by what time? Okay. Um, Forex factory, please. Can we? How can we type this now? Is it? Hmm. Oh, okay. Uh, no, 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 it's fine. Forex factory. All right. Uh, what's the time? So it is correct. All right. Oh, oh, okay, great. It's correct. Yeah, I did not trust. Let me close this. I do not trust this news. I don't trust this news. Oh, let me close this. 450. Wait. So, hmm, it's great. Just leave it like that. Oh, 3335. Imagine. Okay. Okay. Market drag back up. Yeah. All right. All right. Okay. Let's use in a downtrend scenario. So from looking at the downtrend scenario, it has to be from what? From high to low. Is that not so? From the highest point to the lowest point. All right. So let's check out from the highest point to the lowest point on 4 hour time frame. Now, look at this. From this point, can we see this? This market is going all the way up, right? Then from here, what happened? coming down. If we should draw a trend line connecting this is a what? A breakout. So this is a, look at it. Then this place will be what? Your starting point, your lower low, your lower high. Then the next one, lower what? Then lower high, lower low, lower high, lower low, lower high, lower low. Are you following, guys? You are seeing I'm getting it now. From this from this place, starting point, lower what? Low, lower high. The next one is what? No, this is not lower low. Let's start again. This what? Starting point, lower low, lower high, lower high. So the next one must be lower than this guy. So from this place is, then this is the next lower low, then lower high, then lower low. Do you get it now? Exactly. So now that we know the starting point, boom, to this guy. So how are we to know the retracement? So from here, there's this one is loss of momentum. So you are expecting that once it becomes loss of momentum, it's coming up to break above this guy. So now change the structure of what you are looking at. But at the same time, what happened here? It did not get there. So at this point, what will you do? You put it in a box. That wherever it breaks out from, it's what you will follow. And the breakout is from where? Under. So box from here to this point and draw it straight. Anywhere it break out from is where is what is going to, because it did not break above this guy, it did not break below this guy. So it is what ranging as at this point. So you are now looking for the breakout point. Where did the breakout happen? Yeah. So when it break out here, it enters, break out again, and it continues. Do you see that now the body of the candle breaks out below the what? Below this guy. Yeah. So yes, it broke out of the box. So it tells you that this market is what? Coming down. Are you following? But how will you use your retracement? Yes. Mm. Now, let's take this off. And I said you will place it from the what? Now, from this starting point to this guy, to know at which where this retracement will get to for the next what movement to happen. So what will you now do? You take your Fibonacci to the what? To that point. You know, when it was a buying situation, it was from low to up. But because it is a was selling situation, don't forget it has to be on the impulsive low and high. So this is the, we are regarding this as our impulsive. So from the high to what? To low. So to know the point at which this market is going to what? Retrace to. Now the retracement begin, boom. It got to 38.2. Did it respect it? No. So what will you now do? Let's come down to 30 minutes time frame. So we are getting the retracement of this high to this low. To know at which where this retracement we get to for us to start was selling. Are we following, please? better sell before I slap you. Hmm. Okay. So boom, boom, the retracement happened. So when the retracement happened on 30-minute time frame, so what are we looking for us to continue selling? What are we looking for? What are we looking for? A bearish candlestick pattern. Is that not so? Now, when the retracement happened, it got to 38.2. When it got here, was there any bearish candlestick? No. Now, see this. It broke above 50%. When it broke above 50%, boom. Where are you expecting it to go? If you reduce it, you will not be able to see the candles. But you will know what the lines are. Do you get it now? This is your 38.2. This is your what? 50. This is your what? 61.8. This is your what? 76.4. No, let's just continue. We should know these things eh, with our mind, even without looking at the figures. Once you place it, you know that this line is your what? 38.2. This is your what? 50, 61.8, and 76.4. You can see that I use my red line as my what? 50 and 61.8 because those are the what? Eh? Yes, I'm the one that changed that color from green to red because that is the point at which I'm looking at for market to get to now what? Take advantage of the what? Of the situation. This market is so now let's see this. Boom. Market continues to what? All the way here. Boom. It got to 38.2. Any bearish signal? No. It breaks it, went to 50%. When it got to 50%, this candle, this green candle, do you see it? It breaks above it. Now, when it breaks above it, you are expecting that since it has break it, it is going to the next level at what? 61.8. Do you see that now? So when it got to what? 61.8, boom. When it got to 61.8, what happened? The next candle sold down to what? 50. But don't forget, it has broken above your 50% fib level. So you are expecting a what? A candlestick pattern that will give you a confirmed entry to enter a what? To enter a sell. Are you following? Are you following, please? Now, do you see this? Does this candlestick pattern give you any psychology? Is there any information? Now, do you now see that is why it continues to go up? Now, when it went up, boom, it formed a what? An evening star. Can we see that evening star? When it formed the evening star, is this a what? Standard, strong, or weak? It is a standard, right? But when it formed, what happened? Market went up. So if you see this, boom, are you supposed to take advantage of it? No, you are not going to take it now. You will not take it. Why will you take it? Now come back to what? Your 4 hours. Now, now, see your 4 hour. You are waiting for your candlestick pattern to give you a confirmation on your higher time frame. Is that not so? Before you come to your entry on lower time frame. See the first 4 hour candle. Boom. See the second one. Boom. So are you supposed to take a sell here? It has not formed any pattern yet. That is why I said you analyze on your what higher time frame. I come down to your lot lower time frame for entry. Are we following, please? Now see this 4 hour candle. All right, where is it? That is morning star. That is morning star formation. And yes, mm, that is morning star formation. And we are not looking out for a buying situation. We are really looking out for a selling. Now 4 hour candle form, another 4 hour candle form, another 4 hour candle form, green. Now the next candle formed as what? As a red candle. What candlestick pattern is it? Is there any psychology behind it? No. Do you see it now? Until market continues and it breaks above 50 and 61.8. But continue to see, to look out for what will happen, because you are expecting a retracement between each of these what ratios. Then when market gets to your what 76.4, what happened? What candlestick pattern can you have here? Bearish engulfing bar. Are you seeing this now? A bearish engulfing bar. Once you notice a bearish engulfing bar, then you are what? Getting a what? A selling signal. And you can see that the engulfing bar even came back to what? Your 61.8 and to your 50%. Are you seeing it now? So once you get it, boom, you are expecting to sell this market at this point. Yes. You know, once it forms finish, boom, it is at this place. Yes, you will mark it this point. You don't need to use any, just you will just know that yes, you know when it forms finish and go to your lower time frame, it's at that point that it finishes. That is where it will start from now on your lower time frame. Eh? Yes, it will give you see, but at least you know that this is where it stopped. So when you come to 15 minutes time frame, it will continue reading from that place it stopped. So it stopped there, boom, and you are expecting to take stop loss above this guy, and you are waiting for a what? A 15-minute candle for your entry. So what will you now do? You come to 15 minutes or 30 minutes, right? To know your entry point. So this is the level at which the 4 hour ended. Is that not so? This is where it ended. So you are waiting for a what? For an entry. So if you enter from here, if you enter from this point, boom, you will make profit up to this guy. Do you get it now? But where you want to take your profit from is where? This guy. Like I've explained, because you are expecting that it comes down to test this guy and it breaks it to form a new lower low. Are you following? So once you see this formation, boom, and you enter a sell here, your stop loss will be above this guy and your take profit will be at this what? 0%. Then if it breaks it, you are coming to minus 0.27 for your what? TP2. Do you get that now? So that is how to place your what? That is how to place your Fibonacci retracement. That is how you place your what? Your Fibonacci retracement. Let me delete this. Hmm. Let's come back to forward. So with the Fibonacci retracement from here to with the Fibonacci retracement from here to this point, I am able to know that this market will get to the retracement level of 5 and 61.8 to now start looking forward selling opportunity to the downside. So you can now come to lower time frame and start what looking out for possible sell entries. Are you following now? So that is how you place your Fibonacci tool. That is how you place your what? Your Fibonacci tool. Together. All right. That will be part of your top-down analysis. Do you want us to do it now? We can't do top-down analysis now. Mm. And we will continue tomorrow. We will just continue tomorrow. So now, boom. Do you see this now? Market from here to here, retrace to this point, came all the way down from here to here. So for you to now get the retracement of this impulsive movement, you can now take this Fibonacci again from this high to the low. And do you see this market gets to what? 50%. When it got to 50%, what candlestick pattern is that? Bearish engulfing. And when it formed bearish engulfing, it came down to what? 0 and minus 0.27. Are we following, guys? Now, there are exceptions to these things or additions. Hmm? Eh? At your 50%, a red candle, a green candle, a red candle. See this guy, it touched the 50% and it was formed a bearish engulfing bar. It curved the previous green candle and it continues to sell all the way down. Do we get that now? All right. So we will. So I said there are exceptions or additions to these things. Mm. What happened? What are you looking at? Yes. This market moved from here to this low, from this highest point to this lowest point. This one is part of the impulsive movement. So you now want to know the retracement. Don't forget, we don't know what is happening in the future. Market keeps coming down. Then a bullish candlestick, boom. You now want to know the retracement of this bullish from this impulsive movement. So now know where this retracement will end for the next impulsive. Exactly. So this retracement ended at 50%, and the next impulsive movement starts to the downside up to this point. So this what? To this zone. So by tomorrow, we are going to further to know the exceptions and additions to your what? To your Fibonacci tool. Do you get that now? So what do you now need to go home to do now? Look out for an obvious high and low. Do you get it now? And place your Fibonacci tool. And place your Fibonacci tool. Once you place your Fibonacci tool, then look at those points at which you need to what? At which market respects. Do you get it now? Once you get those points, then you can now see how market structure works. Are you following? Look out for candlestick patterns at those levels. See how they react. Learn them very well. Then by tomorrow, we will further our lecture. All right. So thank you. See you guys tomorrow. Yeah, it's going on here. Yeah, it's going on here. All right. Right, sir?